So, moving beyond that, the choices we've got available are, do we record the foreign currency asset and liability at something, like at some way at the initial recognition point in time? And that should be a pretty easy thing to do. So you look at, we borrowed money overseas, figure out what the exchange rate is at that time, and then go, okay, bang, we have it. And we just let it run at that level all the way through until at some point in the future, we pay off that debt or whatever it is that happens. And then if the foreign currency rates have moved against us or with us, then we account for that difference. The fair value approach to it is to pick up those movements over time. So as things move against us, as we get it to each financial year end, we have to figure out what those movements are and we actually pick those differences up. Now, before we even get to what the standards say, what we have to do, from an informational point of view, that second one seems to be a much better option, because that is giving users information about what is currently happening. And to use that information and to be able to be aware of these risks is important. So imagine we borrowed that $500,000 US on the 1st of July. How do we deal with it at the time, and how do we deal with the financial year end? Now what these rates are, these are the spot rates at that point in time. So this is the rate that you could actually get at the 1st of July 2012, and this is the rate when you get to 30th of June 2013, what the rate is. This isn't, and we had a question about it in the earlier lecture, what this isn't the future rate on the 30th of June when you're back here. So this is the rate that you would actually get when you get to this point in time. So imagine those are what the rates are. So on the 1st of July 2012, the Aussie dollar is doing well because it's buying only 97 Aussie gets you $1 US, so we're above parity. And then June 2013, we've dropped below parity. So now $1 US is buying close to $1.10 Aussie. So if we're using historic cost, we'll pick up cash coming through because we've got this foreign currency that we've had brought in, and we credit some sort of foreign currency loan, whatever you want to call it, and that is equivalent to the $500,000 US you've borrowed at the exchange rate of 97 cents. So that $500,000 US is equivalent to about 488. And a good way to think about this is think about cash. Think about the foreign currency cash amount. Don't think about it so much as money. Think about it as just an asset. You've just bought something, and that thing just happens to be US currency. And that US currency value is $488,000 in Australian. If the exchange rate changes, so if this is what we were doing under a historic cost, we wouldn't change it when we get to the financial year end, we just leave it. At the foreign currency rate changes, that liability is actually worth something different. And potentially, and I actually realize I've made a little bit of a mistake in the next section, the asset is actually worth something different as well, because both things move. You're holding a foreign currency asset, as the foreign currency rate moves, that changes in value. So when we get to the fair value point of things, realistically what's happened here, there should be an extra entry, and I'll talk about that in a moment. But just focusing on the loan value has gone from 488 Aussie. That amount has changed from the $500,000 US that we owe. The exchange rate is now 1.09. That means that $500,000 US is worth $546,000 Australian. So we need to recognize that the liability has gone from 488 up to 546. That difference, the 546 and the 488, gets picked up as an increase in the loan amount. And at this point, we haven't discussed what we do with the debit. So we've had a change, and we pick up that change, but whether we put it through into profit and loss, whether we put it into OCI, whether we do something else with it, we haven't talked about yet. What would also happen is if this occurs, and if we're still holding that cash, that foreign currency cash amount would increase in value. because we're now holding $500,000 in US currency, and that $500,000 in US currency was originally worth $488,000, and it's now worth $546. So that actually increases in value. So what you should actually add in, if you've got space next to it, is you would actually pick up debit cash or debit foreign currency cash, if you put foreign currency in front of it, debit cash 58,600, credit question mark 58,600, because that foreign currency asset has actually changed in value as well. So it's not just the liability that's moving, because the cash is a foreign currency thing as well, that changes in value. But regardless, we are showing the change in value of it. That would be a fair value approach to the system. So the issue, if we just focus on the loan, is what is the debit? What would we put there? And also, if we've got some time before these fluctuations kind of unwind, should we be showing all those fluctuations, or should we just leave it? So it's just something to think about. Again, it's useful, and it's going to be useful for the final exam. May well be, I don't think it's useful for this second assignment, but for the final exam, if anything, why do we need regulation? And for an accounting point of view and from a financial reporting point of view, we need regulation because we know people have incentives. We know management have incentives. Now, it's not to say that just because you have incentives, you'll go off and just do horrible bad things, but we know it does happen from time to time. If you've got those incentives, there is a push to show things in a certain light. Now, what was really interesting, and you may have seen it if you did read the announcement I sent through, and if you did click through onto the speech, I mentioned, and I put it up through our Twitter feed, there was a speech made by the chairman of the AASB. He was out in Sydney probably about 4 weeks ago now with the IFRS trustees, just, you know, they were having a meeting out here. But he gave a speech, I think it was titled something like Accounting Moral Hazard. And it is something I would urge each and every one of you to read. It's about, it'd take you probably 5 to 10 minutes at most to read it. But it's a really interesting speech to read because he touches on, towards the end of it, exactly what this point raises, is the fact that even though when we look at the standard setters and when we look at what the statement of accounting concepts tells us that accounting is used for, it is used for decision making, it is used to provide information which is useful to people. One of the key things he says that accounting and what the regulations is for is to stop management abusing the system. Like, he's out and out that said that. So, you know, this is current things which are going on. I would absolutely read it. So the links are there if you need to have a look at it. You know, if you don't want to have a look sort of directly through Twitter, the widget is on the announcements page. If you've seen it, I would urge you to go and have a look at it. Is regulation the only option? Now, I absolutely don't think it is. I also don't think we should have just a complete free market system. Now, I know colleagues of mine are vehemently against pretty much any sort of regulation. They just think regulation distorts markets and causes inefficiencies. I don't think we can have a system where we have absolutely no regulation whatsoever. I don't think that would work. On the flip side, I don't think we can have a system where we're overly regulated, because that does cause problems. So if we had a system with financial reporting of no regulation, what we'd see is companies allowed to do whatever the hell they want. They just put out information, they put out whatever they want to do, and investors would punish them, because if you start telling people the wrong thing, if you start telling people erroneous information, you start telling lies, you start abusing the system, investors are going to stop investing with you. They're going to stop pulling their funding. And if that happens, there is an incentive from the market to tell us properly what's happening. So we can let it be voluntary. And that does work to an extent, but I think there still does need to be some sort of minimum threshold that we have. And we're going to talk about regulation and market forces when we get to the Spotlight series in a second, because that's a really interesting issue which has just cropped up. You may be aware, it's talking about in the last week or so this has occurred. It may be something that you've come across. What does regulation do? It effectively limits choice. Now, this is why free market guys really don't like regulation because they see choice as the most important thing any one of us can have. And none of us like being limited in terms of what we can. None of us like being told what we can and can't do. Realistically, at some level we don't like it. We can understand it as we start. Kids certainly don't like it. No, don't do this. But as you get older, I think you realise that there are sometimes good reasons why you can't do everything that you'd like to do. But I suppose the flip side to that is more choice better? Is having unlimited choice a good thing? I'm not even just talking sort of financial reporting, I'm just talking generally. Is it great having just unlimited choice to do whatever the hell you want? I don't know. I'll give you an example where I struggle with choice, when you have too much choice, and it just baffles me sometimes. And it's a really innocuous little thing, but I don't know, if you do the grocery shopping, you may understand this. Buying toothpaste is a pain in the ass because ostensibly they do pretty much the same thing, and you go to the toothpaste section and it looks like there's hundreds of them. And you get there and you go, written down, I need to buy toothpaste, and you get to it and it's like, Christ, what is the difference? One's teeth whitening. Does anyone actually reckon that teeth whitening stuff does anything? I don't know. I've bought it and it doesn't seem to make a difference, so who knows? But there's 100, they all do different things, or even buying toothbrushes, they all seem to do something slightly different. And ultimately, the sort of really cheap model, I think that does the job well enough. And it's not just because I'm an accountant and think price is the only thing you need to worry about. But having too much choice, and there's research that looks at this, actually can baffle people. If you have too many available choices, you can kind of get stuck. You can kind of look and go, there's too much. It's why people don't necessarily look at what's going on with the superannuation and look at the choices available to them, because even then there's like 6 or 7 choices, and that's not a huge number, and that just gets put in a too hard basket. When you think about it, the amount of choice available in different phone plans, in different private health, Christ, trying to change your private health plan and looking at the different choices, it's why things like iSelect exist, because people at some level hate making decisions on things if there is too much choice. So on one level, too much choice is not necessarily a good thing. But too little choice isn't a good thing. You do want some level of choice. Now, the problem with allowing companies too much choice from a policy point of view is you can't necessarily compare easily between 2 different companies. And if that is what your job is as an analyst, if that's what you're doing from a personal investment point of view, it makes it really difficult to make good decisions. So we do want to see some level of comparability there. So there is a definite benefit to having regulation, even if we do chop off some of the choices available. Now, speaking of regulation, there's actually been another couple of wrinkles with this, which I'll talk about in a moment. The spotlight that we're looking at, some of you guys may have been aware of this. This has cropped up in the media quite strongly in the last week or so. And I want to get some of your feedback on it, because some of you may be younger, some of you may have used this a little bit more than I have. Has anyone been following what's going on with this, with Uber and the new services they were bringing in Sydney? Has anyone got the Uber app? Okay, we've got one. So does anyone know, how many people have no idea what I'm talking about? Jeez. Okay, which is good, in a sense, which is good. So you got the app, have you ever used it? Yeah. Okay, what type of car did you, if you don't want to tell me, you don't have to tell me, but what sort of service did you use?
Just a normal taxi.
Just normal. So that's just a normal, just your boat, like an actual just normal taxi. Do they run it through the normal fare, or do they run it through through the payment system? Okay, so you're paying through kind of PayPal or something like that. So it's not actually, they don't turn their meter on, their proper meter on. Okay, that's very. Do you reckon it would have been? Is that cheaper then? So a normal taxi would be cheaper running it through that way. You'd reckon?
I think normal taxi would be slightly cheaper.
Okay, so as in you think what you paid through Uber was slightly cheaper than getting that same taxi normally. Okay. So what it basically is, has anyone heard of Airbnb? Okay, basically what Uber is kind of like the transport equivalent of Airbnb. So Airbnb, which we used a lot when we were over in Europe last year, is people with private houses, and if you've got a business and hotels could use it as well if they want, but it's basically people with private houses just saying, I've got a spare room, I'm in this city, if you want to book a room, sort of if you're traveling, you want to stay with me, come and stay with me. And so we use it a fair bit. So basically you are going into strangers' homes. Some of our experiences were really good. Some of our experiences were not so good. But you wear that. It was definitely cheaper. The thing is, for Airbnb, the hosts get vetted. So they get vetted by the company. We as potential tenants or visitors, we get vetted as well. I had to upload my send off information about me plus passport details and so on. So they could kind of go, okay, this guy is a real person and we can track him down if he goes on a rampage or something goes wrong. So there is some sort of vetting process. It's not just absolute random strangers. There's a link back somewhere. Now, what Uber did up until about a week ago was to offer a service where taxis could log in. And so the drivers could say, here I am. And if you go on the site, you can actually see them drive, the ones that log in. You can see them driving around your area. It's actually kind of cool. Like, I opened it up the other day and you could see all the taxis just right sort of in my vicinity. And it was kind of like a little version of SimCity, just people driving around. Hire cars can do it as well. So you can get, the HC cars, HC plated cars, sort of the fancy ones, and then you can get even fancier ones than that. And they're all cheaper than what it would have been to have got them normally. Now the thing is, all of those guys are legitimate licensed drivers. So and there was nothing wrong with what they were doing at this point, at least from a government perspective, because they're driving a proper licensed car, they're fully licensed to take passengers and get paid for from passengers. The taxi industry didn't particularly like it because it is chipping away at their profits, but at least it seemed to be okay. Now, April 23, it was around about April 23, a Sydney Morning Herald journalist wrote a story about how he caught a taxi with a stranger. Now, basically what it is was Uber had launched a new low-cost service in Sydney, and it's literally lasted about a week or so. He basically put in his details and said, I want to catch a taxi from here. And what it is they have vetted certain people, and you can sign up to be a driver, and you can basically, in your private car, take fares. You can just say, I'm here and driving around, and you can get paid to just drive people around like a taxi. Now, if that happens, the accounting thing, which I thought was really interesting from that, is taxi licenses are expensive. Now, I was actually wrong when I told you taxi licenses cost you $250,000. They actually cost about $400,000. Now, if this takes off, he was saying the cost to go and the trips that he took was about 50% of the price of a normal taxi. That may mean people start moving away from a normal taxi model and start using this sort of service more. If that starts to happen, the value of a taxi license, the benefit from having it, will decrease. And that may be the fact that this service comes into effect may in itself not be an indication of impairment, but if it takes hold and less people and fewer people start using taxis, that may be an indication of impairment, and you'd have to start looking at the value of those assets. Now, yesterday, the taxi industry didn't like it. The taxi industry in New South Wales is pretty much a monopoly run business. There's a lot of just not great things about that business. Now we've got to be, Cab Charge, if you're aware of it, runs most of the payment systems for it, has a lot of the licenses. There's big issues about what they do. Now, today, I think it was last night, so it's kind of a bit touchy, the chairman and CEO of Cab Charge died. So, we can't sort of talk about him too much in this case. But yesterday, the New South Wales government reiterated on Wednesday, so yesterday, that all drivers need to be registered under the Passenger Transport Act, basically saying that low-cost service which Uber was promoting is not legal. Now, that is very much, I don't know, that's regulation. I don't know if that's necessarily good regulation. It's certainly, I suppose the argument is the benefit to society is that if you're getting in a cab with a stranger, these guys are not vetted properly. Who knows who they're getting in, who knows the roadworthiness of their vehicles. But if you're concerned about that from a user, don't use them. If you are happy to take some of that risk for a cheaper service, should that not be for you to take? You know, and that's where I suppose the difference between sort of a free market and a regulated approach. I mean, I don't know, individually, not asking for a show of hands or anything like that, but I mean, it's really a choice of supposedly a more regulated industry where you know the drivers are who they say they are and are properly trained and all the rest of it, which I don't know is necessarily true in the first instance. Cars are supposedly up to scratch, which again, I don't know if a lot of taxis are necessarily in that position either, versus a situation where you may not necessarily know, but the company is doing some vetting on it. But that's a decision it is now not ours to take. We cannot use that service, or supposedly we cannot. And on that note, we'll take a break for a couple of minutes and get into some regulation around changes, the effects of changes in foreign exchange rates.